Dow futures are hovering right now, up a slight 0.21%. But if you look over at the tech-heavy Nasdaq 100, we're seeing a really aggressive pre-market slide, down nearly 1%.
Right, and the opening bell hasn't even rung yet. It is Tuesday, July 7th, 2026, and the overnight session just completely fractured the broader market narrative.
It really did. So for you listening right now, our mission for today's deep dive is to decode a market that is flashing these just massive structural contradictions right before the open. We are working strictly off our single source today, the Market Intelligence, the July 7th Institutional Strategy Brief.
Because, look, if you're just glancing at the top-line index numbers this morning, you're walking blindfolded into a liquidity trap. The separation between the headline numbers and what institutional money is actually doing is, well, it's a canyon.
Yeah, let's start with the Okra shocker out of Asia, because that's the catalyst driving this tech slide. Samsung reported their Q2 guidance overnight.
And the headline was an absolute monster.
I mean, a 19-fold surge in operating profit. 19-fold.
All right.
Okay, let's unpack this, because a 19-fold profit surge sounds like the kind of news that sends a stock to the moon. But instead, Samsung's stock just plummeted, down over 6% in South Korea.
It was brutal. The selling pressure was so relentless, it dragged the entire South Korean Kospi index down nearly 8% intraday.
Wait, 8%? Didn't that actually trigger circuit breakers?
Yes, those automatic trading halts. A localized market crash triggered by record-shattering profits. What's fascinating here is the sheer brutality of a sell-the-news event.
Right, because everyone expects it to keep going up.
Exactly. The stock market isn't a report card, you know? It's a forward-looking pricing mechanism. When AI memory chips are priced for absolute flawless perfection, the realization of that perfection becomes a liability. The smart money institutions bought into this massive demand rumor like 6 to 9 months ago.
So they were already sitting on massive paper profits before the earnings even dropped.
Correct. So the flashy 19-fold profit headline hits, retail traders rush in to buy.
And the institutions just use that demand as their exit liquidity.
Precisely. They are locking in profits, citing fears that memory chip pricing might taper off. And now, that massive institutional distribution is spilling over our borders. It's heavily pressuring U.S. chip giants like NVIDIA and Broadcom right now in the pre-market.
Which brings us directly to the trap from Monday's U.S. session. Because if you watched the close yesterday, the S&P 500 looked resilient.
Yeah.
It rose 0.72%, closing at 7,537.43.
But the internal plumbing of that Monday rally was completely compromised.
Break that down. How can a rally be broken if the S&P 500 literally goes up?
Well, it's a market cap-weighted illusion. Massive tech behemoths make up such a disproportionate percentage of the index that their slight gains completely mask the reality. The vast majority of individual stocks within the S&P actually declined yesterday.
Wow. So most of the market was bleeding while the index was green.
Right, and the volume was completely anemic. Only 16.8 billion shares traded. That is a full 20% below the year-to-date average.
So it takes significantly less capital to push prices around when trading volume is that thin.
We call it ghost volume. But the real warning, the absolute blaring siren, was the $8 billion market-on-close sell imbalance right at the bell.
And $8 billion MOC sell order right at the buzzer.
Yeah.
I mean, who even trades like that?
Massive institutional players. Mutual funds, pension funds. They execute these block trades at the close to benchmark their performance. That $8 billion is the giant footprint of institutional capital leaving the room. While retail chased that 0.72% headline gain, the smart money methodically distributed shares into that demand. That is the liquidity trap.
They're throwing a massive hyped-up house party just to gather a crowd and then secretly selling all the furniture out of the back door.
That is the perfect analogy.
So if institutions are pulling capital out of tech, it has to go somewhere. And the brief points out the most striking sector divergence today. Tech is sliding, but energy, the XLE, is aggressively capturing the pre-market bid.
Entirely diverging from tech.
Right. We're seeing WTI crude futures pushing towards $69.50 a barrel, and Brent is testing $72.50. It's like the market was entirely obsessed with the digital world and AI, and overnight, it remembered the physical world still exists.
It woke up fast.
Yeah, how quickly can a geopolitical flashpoint derail a tech bull market?
If we connect this to the bigger picture, capital always seeks safety the second physical supply chains are threatened. The brief confirms a severe overnight catalyst. Reports show Iran's Islamic Revolutionary Guard Corps fired missiles at commercial vessels near the Strait of Hormuz.
And there's a southbound LNG tanker ablaze.
Confirmed ablaze. This flight to safety bid isn't just inflating oil, it's aggressively firming the U.S. dollar index. The DXY is up to 100.94 this morning, a 0.09% increase.
Okay, I get the oil spike. But how does a tanker fire in the Middle East fundamentally break a domestic tech rally in the U.S.?
The currency market reaction. When global instability spikes, capital flows into the ultimate safe haven, the U.S. dollar. And a strong dollar acts as an immediate, punishing currency translation headwind for multinational tech companies.
Right, because of overseas revenue.
Exactly. You generate billions selling software in Europe and Asia. You collect euros or yen. When you repatriate those profits back to the U.S., a strong dollar means those foreign currencies buy significantly fewer dollars. Your revenues literally shrink on your balance sheet upon repatriation.
So semiconductors are getting crushed by the Samsung exit liquidity and simultaneously squeezed by this geopolitical dollar strength.
Yes. But the surging dollar is only half of the macro headwind. We have to look at treasury yields.
The bond market. Right now, the 10-year Treasury yield is sitting at 4.51%. That's up 3 basis points.
And that yield is macro gravity.
So what does this all mean? Because we had the June jobs report last week under the new Fed chair, Kevin Warsh, and it was a disaster. Only 57,000 jobs added versus a 110,000 forecast.
A massive miss.
Right. And usually retail investors think bad economic news is good for tech stocks. The logic is terrible jobs report means the Fed has to cut rates, yields drop, and we buy tech. Why is that playbook a trap today?
Because retail is stepping blindly into the pain trade. Yields are refusing to fall. The bond market is looking straight past the weak jobs data and focusing entirely on massive fiscal deficits and sticky inflation. If that 10-year stays above 4.50%, the S&P 500's elevated 21 times forward PE multiple absolutely must contract.
Because investors can get 4.51% completely risk-free from the government, why pay a 21x premium for a risky tech stock?
Exactly. The math demands a downward re-rating. Plus, there is a massively crowded bet against the dollar right now. Speculators have been heavily shorting the DXY. If it squeezes toward 103 or higher, it will absolutely crush global cross-asset carry trades.
It just incinerates them.
Yes. And the supreme irony here, institutional data shows retail actually panicked recently and sold single-name tech stocks. Their positioning is in the bottom 4th percentile, but they turned around and blindly bought broad index ETFs.
So they bought the market cap illusion. But if AI earnings actually beat, the real pain trade is a violent upward squeeze in the exact single stocks retail just capitulated on.
That is the ultimate trap.
Here's where it gets really interesting. We have specific pre-market gappers today that highlight these exact tensions. Let's start with SpaceX, ticker SPCX. It's joining the Nasdaq 100 today under a fast-track rule.
And this triggers an absolute seismic event for mechanical market plumbing.
The brief shows $4.3 billion to $27 billion in forced passive index buying hitting SpaceX today. But the public float is tiny, only 3 to 5%. With billions in mechanical buying forcing its way into a tiny 3% public float, isn't that like trying to push a stadium crowd through a single turnstile?
This raises an important question. How do single stock mechanics completely detach from macro gravity? Today, that stadium crowd pushes through and the price explodes. The tracking algorithms don't care about the 4.51% yield. They have to buy.
The bull level in the brief is $180 to $200, up from roughly $165.96.
Pure mechanical demand. But there is a massive bear case.
Right, former Nasdaq CEO Robert Greifield's warning, an $800 billion insider lockup expiration is hitting soon. What happens then?
That's the bear level of $135 to $150. When insiders can sell, the artificial scarcity vanishes and that mechanical upward pressure reverses violently.
Let's pivot to CRNX Pharmaceuticals, ticker CRNX. Up 99% in the pre-market to $83.66. Vertex just announced an all-cash $10 billion buyout at exactly $85 a share to secure a rare endocrine franchise.
Right, immune to the macro trap.
Because it's pinned to the $85 cash offer.
Exactly. Unless antitrust rears its head. If the deal breaks, the bear case drops it violently back to $41 to $42.
Now, compare that immunity to Micron, ticker MU, record fundamentals. Signed a long-term automotive memory deal with Ford following GM. UBS raised their outlook.
Yep.
Q3 revenue quadrupled to $41.5 billion. It has a dirt-cheap 7x forward PE, and yet it's down 22% from June highs.
Fighting for that $1,000 support level against the Samsung drag.
How does a company with quadruple revenue lose a quarter of its value?
Because it's being dragged down by sector exhaustion. The macro gravity from Asia is overwhelming the individual Ford contracts.
All right, the bull level is $12,255 if it shakes off the cycle fears, but the bear level is $950 to $975 if it loses that $1,000 psychological handle.
A cheap 7x multiple won't save you from algorithms selling the entire sector.
And finally, TeraWulf, ticker WULF, surging on a 20-year data center contract with Anthropic, projecting $19 billion in revenue.
Long-term physical energy infrastructure for AI, it catches a heavy bid even when digital tech sees distribution.
So wrapping this up, you cannot just trust the headline index level today. You have to respect the lines in the sand. For the S&P, the trapdoor is 7,530. If that breaks, the macro floor is 7,380.
And for the Nasdaq, 29,550 is your crucial intraday support.
You have to know the difference between ghost volume and real institutional participation so you don't become the exit liquidity for the smart money.
Exactly. And I want to leave you with this final thought. Think about SpaceX today. If purely passive mechanical index buying can dictate stock prices completely independent of a company's underlying fundamentals, at what point does the stock market stop being an engine for price discovery and simply become a giant self-fulfilling algorithm running on autopilot?
Something to seriously mull over before the opening bell.
Huh.
Thank you for joining us on this deep dive. Stay sharp, respect your levels, and good luck out there today.